Just waiting for YouTube to start live streaming this, and we'll begin the formal talk in around 9:05 New York, which will be in about 5 minutes. Just waiting for YouTube to start live streaming this. Okay. All right. A little echo of me. So a little bit about today. We're going to talk about Monte Carlo methods and model risk management. This is part 2, but I will begin with a review because I know not everybody has seen this, or you may be watching these sequentially on the archive. Actually, the last 2 talks, because of the bug in YouTube, I have on the Dropbox website as Zoom recordings. But if there's some way I can get it into the YouTube area, I will. Otherwise, every other one and everyone going forward should be on YouTube. It was simply an authentication problem having to do with, the incompatibility between a browser and an iPhone instance of something. You'll see that I have a beach scene behind me, so you can enjoy that view. In fact, here in Brooklyn, it's less than 2 degrees Celsius. It's like 1.6 degrees Celsius. Just above freezing. That factors in the wind. Without the wind, it's about 4.5 Celsius. So if you want to enter the chat and tell me where you're from, or if you want to follow up with me later, please tell me how warm it is. I understand we have people joining from South Asia or watching this later on in the evening, and it's probably going to be a lot warmer than 1.6 degrees Celsius where you are. Just getting there's a couple of Excel demos I want to get up and running, just so that they're handy. So about 2 more minutes and we'll start. And a warm welcome to people from around the world. If you're watching this on the Zoom, well, there's only myself on the Zoom right now, so but maybe people will jump in later. There are likely to be people watching the YouTube live, and also people who will be watching this at a later date as a playback. So there are those 2 Excel files. Trying to think of anything else. So what is this one? Oh, this is just something I downloaded. Okay, don't need that. All right, so let me get ready. I'm going to share my desktop, but I'm not going to start quite yet. I'll put up the first slide of the slideshow. Now I don't have my clock up, but I see on my watch it's 9:05 in New York. Okay, I have it's 9:05, so here we go. This is MRMD number 26, that is Model Risk Management Discussion number 26. And it's on Monte Carlo Model Risk Management, part 2 of 2. Last week was part 1. So for those of you who are not familiar with it, this slide just tells you what MRMD is. You can pronounce it mermaid. I've encouraged that, but I haven't actually heard anyone call it mermaid. And so then, what is this about? Well, this is about an extension and sort of connecting with a new textbook that I'm writing with Martin Goldberg and Chandrakant Maheshwari. And we're in print. We will be Academic Press, coming out in January 2026. More about that book later. This is kind of the legal stuff. By entering this, you are consenting to being recorded on video. Also, minutes will be taken by the Zoom AI companion. I'll post those minutes later. And you're being simultaneously streamed on YouTube. Right, so the outline of the talk is first to review MRMD number 25, which was last week, part 1 of 2. Then sections 2 and 3 reinforce some of what we talked about last time. You'll see that a latent hypercube is a variation of stratified sampling. There'll be more on correlated random variables. Last time we just did the simplest case, a 2x2, so I'll progress to a 3x3 and then a more complicated example. The new material then begins in section 4, which is on American Monte Carlo. That is, on Monte Carlo when something happens, so you don't get to the end of all the paths. The first and most common application is for an early exercise option, let's say in an American or Bermudan context. Then I'll talk a little bit about the Greeks. There are 2 ways to calculate them. I'll talk briefly about a Markov chain Monte Carlo, which is a way of modeling a Markov process. And I selected portfolio selection in equity because that's a relevant topic usually for people. Then the final 2 sections talk about the last 2 talks in the MRMD series and the upcoming Storm series, which will be in the same time slot as now. This is 9 o'clock New York on Wednesdays, but this discussion will be generalized to all of risk management and not specifically model risk management. Okay, so here's a review. In this section, we're going to talk about a little bit about how random numbers are generated, what convergence is, which means in the limit of an infinite number of random numbers, what we would expect to get, and reducing the variance to get to those converged results. So there were 3 big topics discussed last week. One of them was generating random numbers. The first is if there happen to be analytic forms. The second is the inverse transform method, which is helpful if you have a cumulative density function, the CDF, or the inverse of that, which is sometimes called the percentile function. There's also a technique called the acceptance rejection algorithm. All of these things were covered in MRMD number 25 last week, so I encourage you to look at that for the basics. We also talked about convergence of Monte Carlo results, which I defined as being both in a one-dimensional case, when you're just talking about the realizations that you're generating converging, and then within that, you're really exposed to the distribution also of the seeds themselves, which are the starting values. Or in the case of more complicated series like Sobel or Halton, you're talking about scrambling the sequence. We'll talk a little bit more about, this, refer to this in uniform random numbers later on in the talk. But this is an example of showing the 2D convergence. So the true number here that we're trying to converge to is 10,000. The price of something is 10,000. On the left axis is the price that the simulation gives you. That is the vertical axis, y-axis. And on the horizontal or x-axis is the number of realizations. So let's just ignore the error bars for a moment. This is the kind of behavior that you might expect, that it's a little ragged, goes sort of up and down, and it does go above and below 0, which you're trying to estimate, but eventually you expect to get closer and closer to it. At the same time, what I found is a phenomenon called seed variance. So I never do this just for only one seed. We had a discussion last week about the book, and one of my co-authors said, well, we always use the right seed. Well, of course, the right seed or starting value is unknown, right? And then what that really means. So my solution is to consider the seeds to be a distribution of their own and to, sample from that seed distribution in multiple seeds. That is what the error bar is showing you. That, let's say I would typically do 10 seeds to estimate this value here. This is 1,000 realizations, and they would be fairly widespread. And they also show a trend typically that they converge more and more as you increase the number of realizations. But it's two-dimensional in the sense that you have two things going on at once. That seems to be a repeat of the previous slide. Let's see, am I going forward? Now I'm going forward, okay. All right, so, and then the third of three topics discussed last week was variance reduction. Normally that means that we exploit some part of the Monte Carlo to reduce what's going on. You can think of that as partially integrating out a completely stochastic problem and doing it deterministically. One of the ways is to exploit covariance using what I defined as control variance and antithetic variance. You can also change the measure and accent, let's say the tail of a distribution. PFE is something I'll mention later. And then you can also just deal with the issue in bins. There are two ways to do that. Last week we talked about data bins, basically cutting up the data in slices called strata. They don't have to be equal in size, but there's a finite number of them. And then the Latin hypercube, which I did not talk about. I think I promised to last week, but did not. So I'm going to cover that next. First, let me just review a couple of these things. So a nice control variate example. Control variate, you remember, is if you have something with a known mean and hopefully a known covariance to the thing that you're trying to calculate. So a good example, and so therefore that means that the thing that you can calculate the mean of is something you can do in closed form, like the Black-Scholes formula for a European option. That's a very trivial example. Here's a slightly less trivial example. This is a fixed strike Asian option. So it pays the arithmetic mean, as you can see, minus the strike price. And I use this notation fairly often to mean the positive part. So this is like saying the maximum of this and zero. Now, the sum of those individual stock prices is usually not a Brownian motion because the sum of log normals is not a log normal. However, the product is, and so therefore a geometric option can be done and can be done analytically because this whole thing is a Brownian motion, right? And so therefore we can get its expectation and its variance. So basically what you do is you would simulate this quantity here, which is, so this is what you wanted to do before, that is explicitly the Asian arithmetic mean fixed price. Then you subtract off C times this, where this is calculable, and this is, this can be simulated, sorry, and this is calculable, the price. And as we showed, there is an optimal C, which will minimize the variance of this quantity, and that is essentially the covariance over the variance. So a little bit more here on stratified sampling. This was exactly what we presented last time, that you can have some variety in the samples in the strata or bins, and each one of them can have, as seen on the right, its own mean and variance. So, but again, you're sampling from the data, you're cutting it up, maybe into high, medium, low, or something like this, a certain finite number of bins that need not be equal in size. So a Latin hypercube, I saw some nice figures and then I couldn't find them anymore. But the idea is that you're sampling, but this time it's a little more abstract. You're not sampling from the data itself, but from the CDF, okay? Remember that the CDF is how you get from uniform random numbers to random numbers. So for example, here's just a Python function that performs the Latin hypercube. And as you can see at the bottom, you basically in some d-dimensional space, you're generating endpoints off of the CDF. So in this case, they're equally sized. All right, now a little bit more of a review of last time on correlated random numbers in the 2x2 case, and then a case of 3x3. I also said that I would do conditional correlation here, but I'm not. But I will talk about the Cholesky decomposition for correlated. It's possible for things like Poissonians to do things that are, outside the Cholesky, but, unless someone asks about that, I can talk about it a little bit in the discussion or just do in follow-up. All right, so last time we had this result right here, that if we start with what we want is we want x1 and x2, which are normal, but are correlated with correlation coefficient rho. And what we know how to generate the independent z1 and z2, which have correlation 0. So one solution to that is to adopt x1 to be the first, and x2 then is this linear combination. And that's the squared is there because you're matching the variance and the covariance. Now, in general, we don't have 2x2 problems. We may have multiple of these, as I'll show an example later. So it's more helpful to go to matrix format. And in this case, in this 2D case, you'll see, I'll work through the example, that the C matrix is essentially these coefficients here that give you, so here you would have diagonal Z1 and Z2, and here you would have the linear combination. So now it turns out that therefore to do C, then to calculate it, we're essentially taking the square root of the correlation matrix. So here my notation is with a apostrophe for transpose, but C times this transpose, which is how you do the equivalent of a square, or by the Hermitian, if these are complex, but these are of course not complex. So basically we need to know the square root of the correlation matrix. That's called the Cholesky decomposition. So first to do the 2D case. So as explained before, the expression that I had for X in terms of Z, it gives you this. So we can infer that this is the Cholesky decomposition. This is the square root of the correlation matrix. Let's just make sure we're comfortable with that. So then C we can read off is equal to this. And so C prime, the transform is this. Therefore, the product of the two is this, which is telling you, that the two have, a correlation of rho. That's it. It's a 2x2 problem. And let's just do that a little bit more, because in general, if you construct a V, it may not be possible to calculate the Cholesky decomposition. There is some special criteria that must be satisfied. One of them, the one that's used the most common, is to calculate the eigenvalues in the ordinary way. And if you're not familiar with calculating eigenvalues or even what that means, please let me know. But essentially, it's the determinant minus the identity matrix times lambda, or this, which has the solution lambda equals 1 minus rho. And we demand, in this case, there's only a single eigenvalue, and its value is 1 minus rho. The requirement is that that be greater than or equal to 0. And since rho is bounded on minus 1, 1, clearly that satisfies that. That's what this line says. The eigenvalues, if I said positive, I didn't mean to. The eigenvalues need to be non-negative. They're allowed to be 0. And that is referred to in the business of linear algebra as having a positive semi-definite matrix. So if you arbitrarily put financial data together and look at correlations between several assets, you want to calculate the eigenvalues. It may be that some of them are negative, and then you have to go to ways to quote unquote fix the matrix, which becomes a black art so that it does have that. A shortcut in calculating the eigenvalues is to just calculate the determinant. Here the determinant we can read off is 1 minus rho squared. Again, that's greater than or equal to 0 because rho is bounded. Maximum value is 1. All right, so there are a number of steps if you want to apply this technique to a practical problem, but bear with me. So you're an investor and you like Meta, you like Google, and you like Amazon. So you go to a bank and you say, I'd like to invest in one of these, which is the best one to invest in for the next year? So the bank will say, well, you know what? We can offer you a product that will give you, it'll pay the performance of the best of those three assets, the percentage return. We're going to cap it and floor it, cap it at 20%, floor it at 0, so you don't lose anything. But then, we have this basket, we have this product. Some of these products, especially when they're maximum, get fanciful names. I believe I mentioned this a few MRMDs ago in the portfolio risk discussions, but that could be called an Altiplano or a Himalayan or I guess a K2 or whatever. So there's a several step approach, but I think it'll all make sense if I go through it slowly. First of all, the thing is to obtain the daily data for the last full year for all these three stocks. From that, we can calculate the mu and the sigma, the mean and the standard deviation. We can also look at skew and kurtosis to see if that's an important effect and see if those numbers are statistically significant. So from that, we calculate a correlation matrix, and therefore we can impute the Cholesky, which is shown before as a lower triangular matrix of 3, 3. We then simulate in the usual way, in this case, 3 independent normals on 0, 1 with a 0, 1 distribution and relate them to the mean and the standard deviation to calculate what we call y. And now we're going to calculate x in terms of y. I use y instead of z because these are 0, 1. This one has the realistic mean and standard deviation. But adding the mean and standard deviation in this way does not change the correlation structure. And then finally, we calculate the payoff. So these are the results. I'm going to pull up the spreadsheet second. Let me give you the answers first. So basically what we find is that, so what's on the screen? Well, first of all, just to remember, there's a floor and a cap on this basket. And basically we looked at it for 250 realizations and took the maximum of those of the basket. So a maximum of a maximum, if you will. If you look at where the individual stocks performed, you can see that they're, just the entire space is sampled in the sense that sometimes, like in this case, Meta has the best return for a year at 6.09, so that exceeds these two. Sometimes Google has the best return, and sometimes Amazon has the best return. So let's see, how are we doing on time? I think, well, let me pop it up for a minute. Let's see if I exit out of this, then I can go and put up the spreadsheet. So basically, here's the stock data, and that's using the Excel stock history function. I then calculate the logarithmic returns, and those are put in statistics right here. In this case, we use 249 returns. You can see these are the mean, the mean of the daily returns and so on. And therefore the variance and kurtosis and so on. Okay, so from these we can extract the correlation matrix of these individual returns, and then we can calculate the first we can check whether it's positive semi-definite, and it is. This is using the Excel function to just calculate the determinant of this, and as you can see, it's greater than or equal to 0. And then I stole someone's code, but down here, and I'm also accidentally minimizing this, but actually that helps a little bit because you can see more. But basically, this is the variance covariance matrix. This is some multiplication and various things. And then this right here is the Cholesky decomposition. I put it down here as well. And I multiplied it by its transpose, so you can see that it actually does equal the variance covariance matrix. I then Monte Carlo based on these, and therefore the y1, y2, and y3 then are these independent normals, but scaled by mu and sigma. Yeah, that's right. I should say the reason that these numbers, right? No, that's fine. You get it. And then E, F, and G, these correlated normals are done by this matrix multiplication, which is the equivalent of C times Y. All right, so this will be up on the website. You can look at that later. I don't expect you to absorb all of this. This took a little time and understanding on my part as well. So let's go back to the slideshow. And now the next topic to speak about is American Monte Carlo. So let's look at the European case. Let's look at the non-Monte Carlo case. Usually we calculate American options because of the early exercise possibilities on a tree or something where we can actually, understand what the exercise surface is, right? Where it's optimal to exercise and where it's not. Now, if then you have something which is a path-dependent option requiring Monte Carlo, and also has an early exercise or some other physics going on inside it, which makes the path somehow not go smoothly, then you have to be a little more clever. There are a number of ways that have been proposed to do this, but industry practice is to use a least squares method, where there's an approximate exercise surface that's generated by regressing the current stock price, the discounted forward, that whether you decide to exercise or not, on the stock price, on powers of the stock price, typically a cubic or a quartic polynomial. That's called the Longstaff-Schwartz method, and the reference is described below. So where would you need something like this? Well, let's start out without the exercise, the possibility of American early exercise. So here's a very path-dependent instrument that basically will pay you, okay, it's going to be the notional times this, but the essential stochastic variable is the interest rate. So in the first period, it'll just pay you something times the current spot interest rate. But in successive periods, it will pay you the difference between the current period interest rate and the previous one. These are both floored at zero. So you're going to make money on this if interest rates are increasing going forward, which could be, for example, if there's a forward term structure today, a sloping up term structure. And you can do that all with Monte Carlo, and there's no reason to have to do this least square method to do the exercise surface. But supposing now that you have a cancelable snowball, which has a put in it, that allows you to sell the product back and cancel the deal. So you would do that, for example, so that you can have an insurance policy. It may be that rates start to go down, and then essentially you get nothing from this, and you can invest better in something else. The question then becomes, when is the optimal time to exercise that put, or is there a time to do that? So that's the type of thing you would do there. I don't have a worked example on that, but let me just generalize this, because it's not always just an American option that's involved. Potential future exposure is also done with an American Monte Carlo, not with an ordinary one. If you remember from previous talks, potential future exposure is sort of like the credit VAR of a customer. It's the 1 year estimate forward of how much credit, counterparty credit, that is losses, from the customer. And it's done, I think I say below here, not on individual positions, but on the whole netting set. I'll describe what netting sets are in a moment. But basically, what's going to happen is that along some of those paths, the netting set may default, and so the path may end. So that's the kind of, it's like an auto call almost, or something like that, that if it goes above a certain strike, it's automatically called. So the math is essentially the same as early exercise. Just briefly on netting sets, we referred to this a little bit, especially in the discussions of, Basel and so on what is a netting set. There's a crucial difference between, I guess it'd be nice to see the next slide. I may say this there, but if you use the basic method of calculating PFE that Basel recommends, the standard approach, or SA, then no netting is allowed. And so that essentially is an overestimate of the amount of credit risk in general, just because there are offsetting positions and cash pledged and things like that in the case of margin. So, but I do mention here the difference between a margined and an unmargined netting set. It's not always necessary for a client to pay variational margin, even if they have to put up initial margin. So with margining, it's a separate calculation. Okay. All right. So yeah, and some of those things on Basel and things have been covered in previous talks, or I can give you, references later. Good. So I think we're about halfway through the talk, and so I think I can probably finish up in another 15 minutes, and there'll be time for questions by chat, or I'll just start making some random comments and maybe wrap the meeting early. All right. So as usual, from a bank's perspective, it's not just all about the price, but it's also about the risk, especially selling a short and expecting the customer to close the position at some point. So this is just a review probably for most people, but just defining what the major Greeks are. They're called Greeks, even though the second one here, Vega, is the name of a star, and it's not a Greek. So therefore, for some reason, people call it Kappa. But essentially, the Greeks are the partial derivatives of the derivative price, or structured product, or whatever, with respect to either the underlying, that's delta, or the volatility, that's sigma, or the rate, or time, or the dividend rate. Or if you like, in a two-currency example, this could be the foreign currency. Those are the first order Greeks. There are second order ones that people look at, particularly for these first two categories. Gamma is the second of this, and then there's a mixed partial and also an ordinary second derivative of Vega called Volga and Vanna. Vanna is the gamma of Vega. The other one's the mix. All right, now, how do you compute Greeks in Monte Carlo? Well, there are two ways to do it. There's only one way in the non-Monte Carlo case. First of all, ideally you would use the Black-Scholes formula, but in most cases you don't have that, unless you're purely a European option. So what you do is, with a tree or with a PDE, you basically perturb things by a small amount numerically, like the stock price by a penny, or the sigma by 1% or 0.1% or something like that. In Monte Carlos, there are two different ways, and so then the question is, which is the more efficient? In some cases, as we'll see, they're the same, but require different computations. So for finite differences in Monte Carlo, well, this is what it is in general. But what this would be a simulation of the stock price, the value of the derivative at that stock price plus a little bit, minus the value minus a little bit. Why didn't I do, just plus a little bit and make it a non-symmetric derivative? Well, this has less noise. Okay, and then H is the small amount. So you would have to do two simulations and then difference them. Now there's some considerations that have to do with that. One of them is that we don't want to really do two different simulations, because then there's going to be, two sets of these things. We really want to do at least a simulation that reuses the same random numbers, both for the theta plus H case and the theta minus H case. So we literally will be using the same, uniform random numbers to then generate by the CDF the normal or log normal and so on. It should be noted that this is in the Columbia paper that I think I referenced on the last slide, or it's the next slide. But anyway, that there can be fairly high errors doing this, particularly if you do these as naively as two different simulations, meaning with different random numbers. But you can get it down to an H squared type of small number here, if you do things properly and if the payoff function is continuous. For pathwise Greeks, really the heart of the explanation is right here, that we are justified in exchanging the order of differentiation and integration. Integration here is, of course, the simulation itself. So instead of simulate the stock prices and take their derivative with respect to price, we simulate the delta itself, the derivative with respect to price. How do you do that? Well, you need an estimator. So for the case of geometric Brownian motion for a stock, of course, this is the payoff, and this is the Black-Scholes. This is the evolution of the log normal price, where z is picked from an ordinary standardized normal. And then by the chain rule, we can show that we can break that up. Essentially, what we're talking about here is this indicator function that we only count the point in the simulation if the stock price exceeds the strike price. Remember that the expectation of the stock being greater than the strike price is the same thing as the indicator function. It's just that's going to be a 1 or a 0 when we have that. So the expectation of that, discounted in the risk neutral measure, is what's going to give us the delta. I also show what it is if you wanted to calculate vega. Now, there are cases where there's digital options. In this case, the it's something that like this, it's harder to do. And then a barrier option where this is, let's say, an absorbing barrier is particularly hard to do. There should be a space in here, but this is basically a European option, an ordinary call option, but with a knockout at if the stock hits this barrier from above or below. All right, so to simplify matters, I created a stock which follows an arithmetic, a quantity that characterized by arithmetic Brownian motion. That is the return itself, because returns are normal, not log normal. And so therefore I'm going to make a price that's payoff where this has a certain standard deviation and mean and a strike price. And so it's an index option that pays when the index return is above 4%. I can then do a series of 1 period Monte Carlos in the usual way, specifying some other things such as the 1-year interest rates. This should be the number 1 and not T. And this is going to be my small change in the stock price, in the return to calculate. So here I have my uniform normals. Here I have what happens when you add in the mu and the sigma. And here's the price of a European call according to the simulation. Then these are the prices, just using these values. This is the entire simulation. Then this is arithmetic. So this is, what is the price of a call on that at maturity if I perturb the stock price up by 1% and down, the return up by 1% and down by 1%. I can then calculate the difference between these two over 2 times del, as I showed a minute ago. And then I can also do it in the pathwise case, which is, and you'll see that in the pathwise case, it's strictly the indicator function here, because we're just looking at returns. We're not looking at the ratio of the stock prices. We're not looking that we have the returns themselves. So this is always going to be binary 0 or 1. This is going to be obviously something more continuous. And so what you see by that, and here, this is what I'm simulating to generate the deltas. So then you can take the mean of, so if you focus on these 2 columns here, these are the statistics on those, the mean and the mean for finite difference delta and the mean for pathwise delta. This just reviews the steps to do them. And then you can see that these are pretty close in the sense that they're almost identical, especially when taking into account the standard deviation. In percentage terms, there's about a 5% standard error in the determination from the fact that we only have 250 realizations. So therefore, these are pretty much identical. So, these are trade-offs. This certainly is, it's another simulation after you did the stock simulation, whereas this is going to require some arithmetic, which also takes some time and resources. Now, I should say that there's some subtleties here, and that you should, as much as possible, reuse random numbers. So in the example I just showed you, as noted, both the up and the down values there use the same random numbers, use the same simulated, in this case, stock price. Now, let's suppose that actually you have this grid, like what I showed before, and you want to calculate the value of something for 1,000, 2,000, and so on, from 1,000 to 10,000 in steps of 2,000 realizations to do convergence analysis. Well, the wrong way to do that is to do it essentially as a triangle number, which means first 1,000, then you simulate 2,000, then 3,000, so that at the end of the day, you've done 55,000 realizations, which is clearly superlinear, and that's because triangle numbers are essentially a quadratic. So the right way to do this instead is, of course, to do it incrementally and cache. So if I want to get 2,000, what I'll do is first I'll generate 1,000 and note the result. And then if I want 2,000, I'll just generate 1,000 more and reuse the 1,000 that I already have. And I continue to do that, and then I essentially have a flat. It's not even, in this case, it's sublinear, what's needed. So for the particular case, it's about a factor of 6 fewer realizations that are needed and resources. So this is the last major topic in the talk, I guess, another 5 or so minutes. And that is Markov chain Monte Carlos. So that, we had been used to thinking about maybe more in terms of individual assets or individual payoffs. But here, what we're trying to do is trying to get some insight on what the best portfolio selection is, given a number of investable stocks. So like the weights and what the returns become. This was covered in the chapter and discussions that I did on MRMDs on portfolio risk. You remember that we talked about the market model and CAPM, the market model being essentially just a straightforward affine model where there's an alpha which defines risk that's other than market risk, and a beta which is the market risk. Here we're showing the excess return of the portfolio above the risk-free rate. In CAPM, the first term goes away, and we're saying that everything is dependent on beta times this excess return. So most people, and these approaches in particular, are frequentist in the sense that they begin with what we can see in terms of state variables, and then they try to predict the observed stock. Should be portfolio, it says potfolio. Okay, so that's sort of a standard thing, but the feeling, especially, I'll talk about Black Litterman in a minute, but is that somehow doesn't really get to what investors want in terms of return and risk. So people have looked at it the other way and trying to figure out, what, given the returns that you want and risk return profile, given the, all right, let me make sure I get this right. So D are the observed, so given the outcome, what would you want in terms of your preferences? That is the Black Litterman model. I should say in passing that Bob Litterman is a really nice guy and is now working on MRM of climate risk, even though he's well on the way to age 75. So in Black Litterman, the idea is that you weight two things, and that's essentially what this is too. There are equilibrium returns from CAPM or from a market model, let's say a least squares model, But there are also the subjective views of the investors. And the claim is that in a Bayesian approach that these two can be put together. So I'm not going to say a lot about this. I'm just going to show that here's a chart from a paper. I believe I give a reference on the next slide. Otherwise, I'm happy to give it. These are 8 stocks. And, the difference, so you want a portfolio of these stocks and you want to figure out which approach really shows you and is sensitive to what investors want. So these are the monthly returns compared, historical returns. Ordinary least squares is the first one. Sorry, not great colors, I know. And then the Markov chain one is the second one. So at least casually you can see that OLS and the Bayesian approach are similar. I won't get into what the other ones are. And that gives you some uncertainty and therefore in the portfolio weights. Good. Well, that was the main content of model risk management of Monte Carlo. It's about 15 before the hour. Let me take 5 minutes and just talk about what's upcoming on MRMD, and just briefly at the end explain how to connect with me and with this talk, especially live, if you happen to be viewing this in an archive. So MRMD itself is the next talk will be on SOFR, which has been around for a number of years. And that's something that around 2000, preparation started planning for it to go away. LIBOR went away, and SOFR was the major US index that replaced it. So I'm going to talk about sort of the progress since then. I would say most of the issues are worked out, but still, there's still literature out there where people refer to things like the LIBOR market model, which are, of course, invalid because there's no such thing as LIBOR anymore. So you have to think about things a little bit differently. The upshot is that there was a scandal involving LIBOR, and that's why we don't have LIBOR anymore. It lived essentially from the 1970s. It's thought that the Shah of Iran was the first really to demand the use of an interbank rate rather than government rates. Now, that talk on SOFR is actually the penultimate or second to last of these MRMDs, simply because on December 1st, we have to start submitting formally our manuscript to academic press. As I described earlier, it's going to be published early in 2026. So I guess they need like a year of lead time to get everything right on it. I don't want to run into intellectual property issues, but I will next week give you an interactive tour of the book. That'll be ahead of the submission. From there, I'm going to shift gears. I'm going to keep the same time and date, Wednesdays at 9 a.m. in New York. I may skip some weeks, but I'm going to try at least to go 2 to 3 times a month and speak. And what I'm going to do is I'm going to generalize this to risk management topics in general, not just model risk. So, for example, I intend to start with 2 topics of securities lending and with FX flow options that often have barriers in them. And FX requires some different considerations, going back to some of the statements of arbitrage bounds, 25 deltas, risk reversals, things like that, that I think it would be helpful to have that language if you're not familiar with it. Storm itself is then this new group. It has a LinkedIn group already, and we have some people, maybe a dozen people have joined the group by now. And this will be the Zooms for Storm, which will start, as I said, right here on December 4th. So it'll be this time slot. It'll have a different name, and it'll be more general. Market risk, credit risk, climate risk, legal risk, operational risk, and so on. I guess I got ahead of myself a little bit. Here is the actual group homepage on LinkedIn now. And you can actually join it automatically in a lot of cases if certain criteria are met. That is, if you're specialized enough in your LinkedIn profile that you seem like a good fit. Otherwise, if it doesn't let you join automatically, then just let me know and I will permit you. I mentioned it once or twice on slides. I don't think I said the words directly, but that I have a consulting business called Delta Vega Incorporated. I'm actually looking for new gigs right now. I'm interviewing. So that could be like a head of model risk position or senior risk positions at banks to do consulting. On my side, I can help you if you're interested in consulting in the US or New York State. And I've done all three types of consulting roles. I prefer corporate to corporate or C to C, but I have done a 1099 arrangement and I've also done a W-2. Okay, and then I just wanted to end with joining, how to join. Sorry, these are jumbled a little bit on the slide. Here is the Delta Vega YouTube chance. I don't know what that means. Anyway, this is the archive. So you can watch it while we're live, and you can also go to it. Just look up by the date. And then finally on later today, I'll put up the slides from these talk that I'm explaining now, the 2 Excel spreadsheets I discussed, maybe 3 of them, in its own folder on MRMD number 26 on this site. I'll also include the minutes and right, and within it, as I said, you can go to this archive and you can pick up the video. Finally, here are my contact points for anyone. Please send me emails. We can have a more formal conversation on WhatsApp if you like. If you're not connected to me already, you can either use this QR code or go to this link. So that's it. Let me stop the share. I see Greg Marpison is on here in New York. So Greg, if you have questions, let me see if I can also start up the YouTube as well to see if people might have questions on that. Here's the slide discussion. The YouTube as well to see if people might have questions on that. Mute myself. Sorry, I don't want to hear myself twice. So here's the chat window. So I'll put any questions. You can't see this, sorry. So I put any questions on that. Looks like 60 people subscribed to the channel already. So you're also welcome to do that. It says 1 watching now, but that's probably me. We have about 7 minutes if people have questions. Let's see, I'm going to try to do this so that I can see the YouTube screen too. Otherwise, I'm happy to give you back the time. As I said before, it's freezing in Celsius. It's less than 2 degrees outside with the wind. It's definitely freezing. On the storm discussion, I'm open to topics. I think I'll start developing that toward the end of the month as we go into the first talk. Securities lending is something I've worked on before, and so that's going to be the first topic. I worked on it at when I was at Deloitte for BlackRock, and when I was at UBS, especially in the context of how CCAR models should be, should reflect that a good bit of UBS's business, especially their wealthy clients, is the lending of securities. So Greg texted me a log normal distribution of returns example. Yeah, so I mean, basically the difference, I can make one of those, or you can make one of those just by grabbing 1,000 random variables from log, and you can generate that yourself in Excel. I might try to do it, but the key difference is Usually the decision between those two is, well, as I said before, one dynamic is that returns are seen to be normal, and therefore that means that the price itself has to be log normal. The price therefore is guaranteed always to be positive, never zero or less than zero, which is a nice property of prices given that U.S. companies have limited liability and can't really have negative capital. Where it came up dynamically is, that's right, returns are normal and prices are, returns are normal, prices are log normal. So that typically, like in that spreadsheet that I had up, the log, I was taking the log of one price, today's price over yesterday's price. So then if the prices are log normal, then the log of the ratio of those two prices should be normal. Right, so just think of it as log of price, or log of today's price over log of yesterday's price. If that looks normal, then that's that. There are other ways to do returns, but in equity it's usually logarithmic. And the other place this came up was when I was at Jefferies. Well, where it came up initially, I saw this in the financial crisis when interest rates started trending to zero and even were negative in Europe. And up to that point, people were using more like the Black-Karaszynski model of interest rates is an important model, but it's log normal, so it's never going to give you zero. And it has some big problems getting close to zero. So people got rid of that model and went to the Hull-White model, which is a normal model. And so that allows negative rates. The log of the ratio is normal. Yes, the log of the ratio of today's price to yesterday's price, right? Or the difference of the logs, because that's the way logs work. So log of today's price minus log of yesterday's price, another way to do it. So like when I was at Jefferies, there was the real question in risk management of, well, we can't always be log normal interest rates because we might have times like the great financial crisis when rates are low. They're trending low again now. But in the midst of let's say the high inflation of 2022, you would definitely want to have a log normal model and not a normal model. So there were some proposals to try to figure out what the regimes were, so that on some days you would calculate the VAR using the log normal model and some using the normal model. Of course, you're going to get different values of VAR. The way that I thought about it, if you're looking back, let's say 5 or 10 years, is that somehow you're smart enough to figure out, given the level of rates, whether you should use the log normal or the normal model. That's one way to do it, to switch. And the other way to do it is to somehow have weights, like, some convex combination. So, two weights summing to one, so that you could be, let's say, 50% of each, or you could be 40% log normal and 50% normal, and that maybe you could fit those coefficients. So then you could have a single model going back 5 years, or you could have, anyway, there's various ways. But the problem is that, we do seem to be in two kind of, in a kind of binomial case where interest rates are large or they're around zero. The Hull-White has a trinomial tree, partly so that rates don't go negative, or they don't easily go negative. So, but yeah, it's something to think about. The simplest models of negative rates just, are like in Sabre, it's a model of the forward, but forwards themselves could also go negative. And so what they do is they just add a constant. So the so-called shifted log normal model. So you could add 2%, let's say, to rates, so that everything, if it were from -2 to 0, would then go from 0 to 2. But then you're introducing a new parameter of that shift, and what should the shift be, and should the shift be constant? So, negative is a problem, and you can bet that in the model risk and the model validations I've seen, a lot of models blow up if you put in negative rates. They just never thought about that, or they do an unseen thing like maybe take their absolute value, which could be really bad. Good. Well, we're just up to the top of the hour, And so let's carry the discussion on, excuse me, online. And I'll get the slides and minutes up later today. Have a great day, evening, night. Hopefully, those of you who are watching this in warmer parts of the world will enjoy life a little more than we are here in New York City. Okay, and hope to see you next week on which will be the LIBOR sort of status discussion. LIBOR, the abandonment of LIBOR, the end of LIBOR, and so forth.